Well, good day, everyone, and thank you for joining the Rock Apartment Transaction webinar. We've got a really terrific session for you today. And today's session, we're going to focus on the mid-market opportunities to buy, sell, build, and profit from buildings in the mid-market. We call that 8 to 80 units. And we've got a couple of guests with us today. So I'm your host, Darryl Lobo. We're going to show you a striking picture of me in a moment. And the other way, Carmen, yep. And then we've also got two special guests on here. Our first guest is Darryl McCullough. Darryl, good afternoon.
Good afternoon.
Okay, good. Welcome to the session. Darryl's our broker of record, and Darryl's been structuring apartment deals for 40 years, and he's done just a ton of deals in the mid-market across all asset classes, including apartments. And our other guest is Phil Deschenes. Phil's been a friend of Rock for a number of years. Phil, who are those two good-looking young people there with you?
Well, good afternoon, Derek, and happy to be here. Those two children are Thomas on my right and Bridget on my left. We're visiting Washington,
Where is that?
D.C.
Is that the White House?
It is. Unfortunately, I wasn't invited in. My lovely wife is taking the photo, so she's not.
Beautiful, beautiful, beautiful. Great. Well, welcome and thanks for joining us. So in this part of the presentation, what we're going to do is we're going to really focus in on the mid-market, and I'm going to make some general comments first on the mid-market. Okay, so we have many buyers call us, and they're saying, we want to buy small apartments. Okay, well, where do you start with someone who just gives you that much of a description? We'll buy anywhere in Ontario, kind of any size, any price. Well, it's impossible to sort of work with someone in that sector. So the purpose of today's session is to talk to buyers and sellers about the mid-market. Now, if you think about our industry, we're in a classic high-demand business with low supplies. We've got way more buyers than there are sellers right now. But as Darryl, we were talking earlier, there are 25,000 apartment buildings in Ontario, 6 units or more, right? And very few apartment buildings are for sale officially. But you know what? We've done 70% of the transactions in our company have been deals that never would have been done if we didn't approach the seller. So we have a process here that we call sort of, buy-side brokerage, where we work with buyers on a formal basis. We'll talk about that a little bit later on, and we go and look for a product for them. But we can only look for, Darryl, we call this person a counseled buyer. What do we mean by that term, a counseled buyer?
Well, traditionally, we really need to spend, if we're being honest with ourselves, probably a minimum of 2 hours initial meeting with a buyer before we even start talking about going and looking at any product. One of the reasons is there's so many different haves and wants, and we'll talk about that a little bit later, I think. But really it comes down to understanding the buyer, their needs versus their wants, those requirements, and their abilities, and what type of buyer they are. And it really helps us to help them when we take that initial time to do it. It doesn't make a whole lot of sense just to run hither and here and there and not have pre-counseled the client. It's to everybody's benefit to sit down and spend some time getting to know each other.
Okay, good. So let's go on the next slide. This is the mid-market, or this is the apartment universe in Ontario. And what you'll see is that there are, very many buildings, 38,000 buildings if you include the ones under 6 units, right? So if you think about it, like if you look there between 6 and 10 units, there's 8,000 buildings. Between 11 and 20 units, there's 4,600 buildings. Between 21 and 30 units, there's 2,300 buildings. If you go all the way to the big buildings of over 500, there's only 63 complexes in Ontario that size. And everybody wants to kind of, be the big game hitter, in the brokerage business and sell the larger building. But there are so few of them relative to the mid-market, right? So you can see that if you look at under 6 units, there's 13,000 buildings in that marketplace. And there's not a lot of, let's call it, sophistication in that level of the marketplace. It's typically done by agents who are selling single-family homes, car washes, land, and things like that. No one's specializing on it. And Rock has made a determined effort, really, to focus in on the mid-market and bring institutional quality service down to the mid-market. Phil, any comment on just this stratification of product in Ontario in the mid-market, just how much product is there?
Well, yes, Derek, absolutely. In sheer size and sheer numbers, it's a fantastic table. It identifies how many buildings there are under 40 suites. The way I'd like to chip in on that particular point is that REITs have driven a lot of transactions in the apartment market in the recent past. And REITs generally have a size threshold, which is to say in many cases they won't buy complexes under 40 units. So that takes a significant purchaser, driver of the market, out of that marketplace, which opens up smaller buildings, the smaller building market to private investors.
Right. So let's go to the next slide. Then let's talk about, so why are buyers coming to the mid-market, right? In the second half of this session, we're going to show the sales that have occurred this year. And last year was a record year for sales in Ontario. About $2.9 billion in sales occurred. And in previous years, you had $3 billion in sales across the country. Now you had almost $3 billion in sales just in Ontario. So the mid-market is attractive, and I think it's for the following reasons here. Number one, investors who have money are really tired of the stock market. There's stock market fatigue, right? A lot of people got hurt in 2008 and 2009. Interest rates are at incredibly low rates, right? 2 and 3% money is now available in that 10, 5, and 10-year range. So they don't like the volatility of the stock market. They don't like keeping their money in the bank because they're getting almost nothing on their money. People understand apartments, and I think that's bringing a lot of newer players to the market for that reason. They're liking the 5% returns they're getting. Then they leverage that up with some cheap debt. So their leverage returns are quite attractive. Any comment on why people are coming back to why people are coming to the mid-market, Phil?
Well, I think you hit the nail on the head in the context of that they're looking for alternatives. They're looking for alternatives that will give them cash distributions. Apartment buildings are very stable in the context of income streams, and leverage returns are available through access to very cheap debt capital. The barrier to entry in the mid-market, particularly the lower end of the mid-market, is available. At 25% down on $1 million purchase, well, it's $250,000. So it's doable.
Affordable by a lot of people. Yes.
Absolutely. And I think something that a lot of people are turning to that don't necessarily have experience in the multifamily sector is putting the asset in the hands of professional third-party property managers, thereby making that investment more of a passive experience. Yeah.
Darryl, any comments on that, especially on the property management side, right? I mean, these are active investments when you buy an apartment building for mid-market buyers.
Very active, and they're coming. I just feel that Phil has hit the nail on the head and you have too. Why they're coming, and the down payment, and the relative safety and long term, and it's clear. I mean, we can talk about it, but the reality is that we're getting pushed all the time by buyers that are scrambling to find product, and because there's disposable money to spend, and there's very few markets that'll give them the returns in the long-term returns with the risk greatly mitigated than apartments.
Right. So let's talk about now. So we've got people who are saying, look, I'm tired of my other investment choices. I want to get back to basics. I want to have something I can kick the tires on, some pride of ownership, something I leave to my children, something I can work a little bit to increase the value, whereas you can't change the stock performance. You have no impact on it. You can certainly change the performance of a small apartment building that you buy. So where in the mid-market are buyers going to invest? So what cities are they going to invest in? Now, Phil, you were part of this. When we did the ROC report in 2012, we ranked all the cities across Ontario, right? Mm-hmm. Yeah. And so let's just go back and chat about this. But Darryl, first, just make some generic comments in terms of, Darryl was involved in this process also about how we ranked buildings and how you've got to be careful with how you use this information.
Well, these ROC report rankings were based on a series of 12-month forward-looking economic supply and demand variables.
Correct.
A group of appraisers, including Phil, assisted and contributed immensely to this ranking. But if you don't have a copy of, if you don't have a copy of the ROC report, please get in touch with us and we'll send you one right away. But the interesting things about this are, with these rankings, we need to keep three important points in mind. Firstly, a careful chosen property in a bottom-ranked market could easily outperform a poor choice in a top rental market. Secondly, a market facing difficulties in the near term may provide excellent long-term prospects and vice versa. We're going to talk about that in a second. Third, a market's rating may fall from one year to the next, even if its fundamentals are improving. And it could be new construction. We won't go further there. Therefore, the differences in these rankings should be carefully interpreted. A top-ranked market is not necessarily twice as good as the second-ranked market, and also nor is it 10 times better than the 10th-ranked market. And I just wanted Derek to take two specific situations here. If we go to Niagara, which was ranked 31st, Steve Keeley, our Niagara and Hamilton Wentworth broker associate, notes that as of February 2013, in Niagara, there are only 21 buildings for sale of 5 units and over. Normally, at this time of year, there historically has been 35 to 40 for sale. There's a seller's market that has evolved. Also, the historic number of buyers from, this is interesting, the historic number of buyers from the GTA who purchase in Niagara has been around 30 to 35% historically. However, in recent years, this has steadily been increases to where now 60 to 65% come from the GTA, particularly in the last 2 years. So we can conclude that these same investors, for the most part, have been chasing yield. Now let's go to Windsor for a minute, which is very, very interesting. First of all, let's look across the river to Detroit. Even though a city in deep financial trouble, encouraging employment gains and an auto industry revival is supporting an improving apartment market this year. So we see vacancy rates that have gone from 7% in 2010 down to 4.5% in 2012, with projections under 4% in 2013. Interestingly, its lowest level since 2001. So when you put job growth in professional and business services, education and health services in Detroit, which complement the revised auto industry, we see what's happening. What influence would this have in Windsor? Well, we see the reality of a 14% overall vacancy rate now scaled down to 7% and dropping. Right. So when we look at these markets, we've got to drill down much deeper.
Yeah, and this was a very high-level overview, saying, you know, all things being equal, if you could find an identical building in Vaughan, right, at a 5 cap rate, or that same building in Windsor at a 5 cap rate, then you're going to buy it in Vaughan, right? So the whole idea was to just kind of look at the marketplace at a very high level and point out the cities where we see, you know, high growth, low supply, and things like that. So that's why we like Vaughan, King, and Richmond Hill. There's hardly any apartments up there. There's like 0.3 apartments per 100 people, while as Windsor, Niagara Falls might have 6-7 apartments per 100 people. Strong population growth and so on. Phil, you were involved in these rankings. We had a lot of debate about this.
We did, and we had many agreements and a couple of disagreements as well.
We did.
And I think part of the perspective is I'm a big proponent of small-town Ontario.
Yes.
Not just because I live in Barrie, but but because I see tidy, well-run buildings in small-town Ontario, such as Belleville or Lindsay or North Bay. And these buildings are offering yield enhancement of maybe 100 to 250 basis points over GTA based yields. Right. And when you leverage that type of differential, you know, at a 3 or 3.25% 10-year mortgage rate, it's significant.
A lot of cash flow.
It's a lot of cash flow. I also like the small town because of the focus on the senior market and the opportunity. These towns they're regional centers of sorts, and all the surrounding smaller communities or villages, generally speaking, the retirees are coming in to these secondary markets, access to health care, that sort of thing. So I think that the senior market, an aging market in secondary centers, offers a wonderful tenant profile. Also, and I should add, you know, piggybacking on Darryl's comment with regards to the Niagara region and the involvement of GTA investors in the Niagara region, I think that there are still many, many opportunities in small-town Ontario and mid-size, secondary urban centers such as North Bay, Sault Ste. Marie, in getting a good property that hasn't been picked over by the large REITs or the larger corporate investors that are GTA-based.
Right. But I think we would all agree that, our rankings of 1, 2, and 3, Vaughan, Markham, Ottawa, Oakville, Burlington, I mean, those are just solid places to buy apartments. And why we ranked them so high is because there were so few apartments to buy there. Do you see my point? So those became real jewels versus if you go to Kitchener, which is a great city, there's lots of apartments to buy in Kitchener, lots of apartments to buy in Hamilton and places like that. So we took many, many things into consideration here. And certainly if you were building apartments, you can build in these in the same markets for the same reasons that you guys have discussed. So we want people to understand that this is a very high-level overview, but it does compare one city to the other, right? And Darryl said, if you want a copy of the Rock Report, it's a 72-page document. Please contact us. We're happy to mail it to you. Okay, so we did another slide here, and Phil, you submitted this to us, and thanks for doing that. What did you want to show our listeners here?
Well, when we the slide originated with you sharing with me a number of transactions that we were going to discuss later on in the webinar, and it occurred to me that a handful of them had sold in the past and had resold in the recent past, and I thought it would be a worthwhile exercise to demonstrate just the rate of change that an investor can experience or has experienced in the recent past in the apartment market. And
it's been stellar, hasn't it? Why don't you go through those? They're unbelievable numbers.
Yeah, absolutely. Well, the first two properties are really nice buildings in a very, very strong rental location near, let's say, Walmer Road in St. Clair in the Forest Hill. Yeah, Forest Hill. And there are a couple of properties that were bought by a private investor and resold to an investor that's acquiring a large number of properties in Toronto in the recent past. And just running through the table to the right, I mean, the rate of change in the first property was 173% over 168 months, which equates to annual appreciation of 12.4%. But keep in mind, generally speaking, a purchaser is coming up with somewhere between 15 to 25% of purchase price.
So it's leveraged.
Yeah, absolutely. If you're to leverage that annual appreciation or just divide it by 0.25 or a quarter, that's a 50% annual rate of appreciation on equity, the cash in, over the holding period, excluding amortization and excluding annual cash distributions or cash flow. And you can carry on down. 5 Dufresne Court sold and resold. It sold in September of 2003 for $16.6 million. Resold in February of 2013, very recent sale. It's in the discussion later on for $23.3 million. 40% change over 113 months is you might look at 4% as a paltry annual appreciation, but on equity, it's 17% per annum.
Sure.
Yeah, and there are other examples in Kitchener, London, many examples. I think that past performance isn't necessarily a guarantee of future performance, but we've seen steady rental growth and cap rate compression from 2010 through to 2012.
Right, but Phil, I think your point is that there's been this really stellar growth in Toronto and probably in Ottawa, and maybe that hasn't happened in the smaller markets, so there's still some opportunity there.
You're absolutely correct, and in fact, going back to an earlier comment that I made, you can buy a property such as Russell Hill in Toronto at a 3.5 to 4% all-cash rate of return or a cap rate. If you were to go to North Bay or Sault Ste. Marie or Sudbury, you could buy an asset at a 6.75 to a 7 cap, and receive fantastic leverage returns.
Yes.
And the possibility that, not the possibility, I would say absolutely, you're going to see continued pressure on secondary centers by REIT purchasers and private purchasers to consolidate and to continue to grow their business.
Yeah, I think those are some great points. Darryl, any comments on that?
No, I have to agree that the appreciation is something not that we look at, but if we start talking about what our goals and objectives are, or what type of buyer or investors we are, we're going to be expanding on this because it really has a bearing. You know, we can talk about short-term yields, but we're getting into many situations now where investors are looking for long-term capital appreciation just as much as short-term yields.
Okay, great. Okay, excellent. I think some really good points. So let's go on to the next slide and let's talk about, Darryl, I could maybe lead this little section over here, is to determine what I want to buy. What type of buyer am I? So what do you mean by this?
Well, basically, when we look at things from an umbrella perspective, this is an apartment building. There should be everybody interested in it, but you really go back to the consulting side of this business, and we really got to drill down to know what type of buyer that we really are. Sometimes we have to talk about that to really understand, and let me share why. If I'm an institutional investor, I'm going to be looking very hard, not only at our going-in cap rate, but just what Phil talked about. I mean, long-term hold, where are we going to be down the road? What's our anticipated appreciation based on a lot of history and going forward? So if I'm an institution, I'm going to think that way. A passive investor may not be buying the large portfolios in institutionals, but they have the basic same criteria. And we're seeing more and more where we're getting investors that are getting near retirement age, and they want to get investments into long-term estate planning vehicles. And we're finding very, very interesting dynamics there where they could be in their early 60s, early 70s, and they want to get good quality hard asset multifamily properties in their estate planning process. So they're looking at long term for their estate. An active investor, on the other hand, is somebody that's coming along and saying, I am in the business of real estate. I have to see where I can find a gap in this, where I can add value through repositioning in the rental or a combination of rehabbing, and that also falls into the builder, developer, and fixer handy area, because all of those are the business of real estate, where I see an asset, what can I do to add value in that 18 to 24 month window, and then I can see my appreciation go. I may then choose to sell into the marketplace at a repositioned asset, or refinance it and hold it. Those are options that I have. But my first goal is to be able to add value and use my talent. And if I'm a user manager, I have a strong management background that says I can help this property. I see management issues that I can help and turn around, and I'm going to use that expertise in buying this asset. So we're basically talking about completely different thought processes to buy buildings, and I see it more and more every day where there are distinct differences in what people's needs are in acquiring apartment buildings.
Right. So we're talking now about counseling our clients about what their investment objectives are.
Yep. Mm-hmm.
And depending on their investment objective, it's a very different process. We've got some clients who you've mentioned, they're interested in someone building them a brand new building. Absolutely. So that it'll just be quite passive. It'll throw off cash flow for themselves in their older age and for their children when they pass on. Right?
Correct.
Interesting that we've been able to. So I've just flipped to the next side, determining what to buy and what are my investment objectives.
Sure. Right? Our long-term passive appreciation, we have a tendency to be talking cap rates right off the bat in all instances, and Phil will be doing a lot of that in the next segment. But we also are looking what we call, and we won't confuse the issue, internal rates of return are what we deal with in long-term passive appreciation, because we are competing against the stock markets and the bond markets, and yes, where people can put money away for long-term. So we gauge our long-term investments against those fixed indexes. Opportunity to exploit talents and rehab, as I said before. I mean, there's no sense in showing a turnaround guy a long-term passive investment. That's not where. A lot of times these people need to work, need these deals. This is how they make their living. So Short-term high yield, we talked about maybe saying, I am not geographically bound. I will go outside of where I live. I will travel to get the yield. And as we're going to see more and more, and we're doing so much of it now, building new construction because of the obvious gap in the market, and that's an exciting new area that we're dealing with extensively now.
Okay, great. So we've made, for those of you that are watching, if you want to go to our webpage, we've actually made a video titled How to Buy an Apartment Building. And at ROC, as I said, a large number of our deals are buy-side brokerage, where we have some kind of buyer agency agreement with the purchaser. And we work for the purchaser to find them a building, and the purchaser pays us the commission because we're working strictly for them. So there's a video there that you can go and find on the ROC webpage where we go through an example, sort of a theoretical example in the city of Oakville for someone who wants to buy an apartment building between 20 and 40 units. And we show them there are only 22 buildings like that, and how we search them out, how we scored them, how we ranked them, and then how we put in, unsolicited offers on those buildings, right?
Just to complement that, Derek,
yes.
ROC and Dalla continually focus on being students of the multifamily marketplace, and their full-time research is to complement our business model. What does that mean? It means throughout this continual research, we seek out where demand gaps and quality exist in the rental market, representing buyers. So that's the interesting part of the buyer brokerage side. In effect, we're postal code investing for them.
Yes, indeed. We'll describe that a little bit more in a minute. So the next thing is Darryl, when we're selling mid-market buildings, it's very important to underwrite the property properly. A lot of times brokers will underwrite a $2 million building or $3 million building incorrect, and then the deal falls apart on due diligence, because then the real eyes come out. The appraiser's hired, the banker's hired, and they start looking at the pro forma the broker's put together, and it doesn't hold up to the test.
Correct.
Darryl, any comment on underwriting mid-market apartment buildings? It's very easy to overprice something and then have the deal put under contract and have the thing retraded and fall apart.
Well, I think it comes back to what I said earlier. I mean, it all comes down to relationships with your clients, being able to share with them the good and the bad, and go forward in that mode. But as far as the due diligence, we like to spend. Some people could say we've gone to market with you, and 48 hours later, how come we're not exposed to everybody right away? Well, we've got a lot of due diligence to do, a lot of in our packaging and so on and so forth. We want to be ready for the market, and then we want to make sure that our client has everything we need so that we can share that with the qualified.
Phil, any comments on underwriting in the mid-market? Because a lot of times, investors manage their own building, right? So when they give you their financials, there's no management fee in there. And the repair and maintenance is, very low because they're doing all the work themselves and things like that.
Sure. Well, Darryl spoke to the idea of strong relationships, and there's no doubt that ROC has strong relationships with the mortgage brokerage community. And when it comes down to it, you do know how a mortgage broker is going to present the income and expense statement of an apartment investment to a lender. Lenders have parameters that they work within. Not that they're altogether rigid, but to a degree they'll have industry benchmarks for repairs and maintenance, for payroll, for insurance, for vacancy, and then the capitalization rate's obviously very critical as well. So I would, with certainty, say that ROC's understanding of the process would put you into a position where you would be offering quality advice to your clients in the context of what's doable, and obviously you don't want to have another $200,000 cash call on closing.
Exactly, and that's the point. So let's say you were buying a $2 million building, okay, and you thought you could get 80% financing on it, right? That means you've got $400,000 to put down and $1.6 million for financing, right? If that property is underwritten incorrectly, the bank only advances you $1.5 million, you've got to find $100,000 on closing day, right?
It can be uncomfortable.
And that's why sometimes deals fall apart in the mid-market, because they haven't properly been underwritten and they get tied up and they get dropped, and that can be a bit of a mess. So you want to make sure that when you're dealing with people that you've got a broker that understands that not just getting the highest price for the seller or for the buyer, but being able to underwrite and get it financed based on the down payment that they have, right?
Yep.
Okay,
Absolutely.
So in that video that I talked about earlier, I'm going to go. It's a 8-minute video talking about how to buy in the mid market. But let's just talk about a couple of things here. Darryl, you said earlier you want to acquire by the postal code, not necessarily by the city. What do you mean by that?
Well, it's interesting. I mean, just we're talking every day to our brokers and even our brokers that we deal with on a third-party basis. And
Our co-brokerage program.
Co-brokerage, and also the in-house guys. And we're basically, the sophisticated mid-market buyer is very interesting. It's not necessarily them being near the home where they actually live. They're really interested in finding, and we talked earlier about Niagara and Windsor, these areas. They're very interested in going into these markets and then searching out the best areas in these markets. So when we refer to postal code investing, we don't look at a macro of that particular market. We drill down to the micro, and you can certainly tell when you're driving around. You get a sense of areas that are a little better. So that's a buzzword, postal code investing. It really tells us to drill down into certain neighborhoods and say these are strong neighborhoods. Why wouldn't we take advantage of a market that may be soft on a macro standpoint, but has great upside if we locate in a specific subdivision or specific area in that market.
Right, and you know, we have a research department that's doing that work all the time. Let me give you an example. Earlier on, I showed you a list of all the cities. We ranked them 1 through 31. Now, we ranked Toronto as 7, but Toronto is a huge number of apartments. If you broke down Toronto into areas, I mean, Yorkville would sort of be center ice, right? Mm-hmm. And so York would be absolute number 1 of any list you do anywhere in Ontario, right? So that's the point we're making. It's the sections of the city that you want to invest in. Darryl, right now we got a building for sale in Ancaster, right? Ancaster is tied to the Hamilton market, yet incomes in Ancaster are higher than Oakville, right?
That's right. It's amazing.
So there you're buying based on the postal code. Phil, you see my point there?
Absolutely. Yeah. I do. I think that you need to support that type of decision making with a significant amount of research.
Yes.
And if you have the infrastructure, then you have the advantage. So really, it's information.
Yeah. No, you're 100% right. Okay. So Darryl, we here at Rock, we've got a bunch of guys. We just focus on the apartment business. There's 26 of us at this point in our firm, and a good part of our business is what I refer to, you know, buy side brokerage, or, you know, buyer agency, where we get a mandate from the buyer to go and buy apartment buildings. And I think our sort of just wrapping up everything is, you know, we have to counsel our client before we're going to go and start looking for apartments for them. I'll just kind of tie that whole thing together.
Well, basically, you have the whole market that opens up to you, and that really makes a huge difference. Not just what's formally on the market for sale, but for people that are you know, people that may not be even thinking about sales. And Derek, you certainly closed a number of situations where people originally never even thought they were going to sell, but you brought the buyers along. But I also want to just break down, when you were talking about that from the buyer standpoint, we have the opportunity to determine what we do want to buy too. And we have, you know, we're talking about lifestyle renters. You know, we may be in a marketplace where baby boomers, the 46 to 1964, and the families are where we're going to be needing. The Generation X are the people that we would probably see the less of today because they've been to houses. But think of Generation Y, born between 1980s and 2000s. We're seeing some very interesting things going on in downtowns like Toronto and Kitchener, where the innovation sector is taking over and is changing all those neighborhoods. Those are, you know, when you're looking at determining what to buy and you're in that, it's very interesting. And that's you know, what kind of buyer are we? That's just an added thing that we do in the consulting side. Is you know, we talk about what kind of buyer we are, but what are we really interested in? We have lots of people who say, I want to get to those baby boomers, you know, and we know for sure that baby boomers are certainly lifestyle renters if they could find the product to rent. It's just not around. We need to be, you know, looking at new construction and rehabbing buildings for these baby boomer generation.
Sure, and And for our listeners, we've got a lot of information on our website about new apartment construction, and every year we hold a new apartment construction symposium for them, to attend. So I think just want to wrap up on the buy side piece here. So what we say to clients is, look, if you tell us we can buy you the building you want at the price you want in the area you want if you do the research and understand the market. Just keep in mind that, we're very careful in who we select to work within this area. You need to have a good understanding of the business. You need to have your capital raised, and we charge a retainer to our clients before we start doing buy-side brokers, and it's a way that we qualify them. But a good formal 30% of our business is buy-side brokerage, and 70% of the deals we do tend not to get listed, and but we sort of create that marketplace.
But Derek,
so I want to thank. Yeah,
the retainer is such a small part of. You're
it's tiny.
You're talking the money that's involved and the need to get good information. It's such a small part of the overall investment vehicle that you're looking for.
Yep. So there's Darryl's contact information. Phil, I'm going to leave your contact information up there for a moment. So we really think that this mid-market is it's the fat part of the market, right? And so we want to thank you for joining us for this session. We're now going to go on, and we're going to talk about the Rock Apartment Transaction webinar. And here what we do is every month we just focus on the transactions that have occurred. And we're going to do this in about 20 minutes and quickly cover all the the major transactions in the last 30 days, being now towards the end of February when we're presenting this webinar. We've got a number of other webinars coming out. They're scheduled right through till December. We also want to welcome all the brokers who joined us here. Rock, we really focus hard on co-brokerage. If you're interested in the co-brokerage business, please call us. There's a number of videos on our webpage on co-brokerage. There's a 1-hour webinar we did recently on co-brokerage with Darryl, myself, and Harvey Russell from CB. We also want to thank the folks at RealTrack for the information that we're going to now present to you. So, Phil, we're going to walk through these sales, fairly quickly. I'm going to ask you to comment on some of them, okay? Here's the summary. In the last 30 days, we've had another 49 transactions that have occurred, and so we've seen 2,300 units already sell this year, and still early in the year, about $250 million in sold. So we're on track with sort of last year's numbers. The average price per unit, Phil, look at this number, $140,000 per unit so far this year.
It's a remarkable number. I recall when six figures was a bit of a glass ceiling, and there's no thought to it any longer.
Yeah, I mean, when you got over 100, you said the world's gone crazy, right?
Mm-hmm.
And then all of a sudden now the average price $140,000 in Toronto. We're going to get to the largest sale and also the largest price per unit sale. So again, every month we showed, there's been, the transactions that have occurred in the GTA and broken down. And interestingly enough, normally the GTA always sort of dominates, but you can see a number of sales have been made in southwestern Ontario and Hamilton, Niagara areas, as well as northern and eastern Ontario, which we put in groups. So Phil, let's just quickly walk through some of these sales, okay? And there were too many sales to show you here, but we just want to pick some out that sort of made the point.
Sure. Well, the first one's a very tidy little building, wonderful rental location on Bathurst Street between St. Clair and Eglinton. I don't think that this building would trade as much on yield as it would on say, a unit rate, on a price per unit.
Right, and it's 235 is a big number.
It is a big number, yeah.
Okay,
yeah.
Next one. Yeah. So we picked this one here, Phil, also. This was, sold for $157,000 per unit.
This one caught my eye just because it's just so darn attractive, and
yes.
Nice site, actually a good sized lot, given the number of units, and the unit rate to me does not seem high for
no.
Burlington and for such a quality property. Also,
right.
Worthwhile noting, at $1.1 million, the barrier to entry is not huge. At 20-25% down.
So if you have $200,000-$300,000, maybe $400,000, you can buy this building, right? And that's within the capability of a lot of people out there.
Absolutely.
Okay, good. So here we picked a building in Toronto at DuPont and Bathurst.
This one jumps out at me for a couple of reasons. One, unit rate is huge at $367,000 a suite.
Huge.
Yeah, absolutely huge. The 1910 jumps out at me. It's an older building. I
yes.
Took a good look at the property and scanned it on Google, and I don't want to sound negative, but the pictures on Google weren't particularly flattering. So, gee, it's
so sometimes I wonder if these aren't redevelopment plays where the guy's thinking of the underlying land value, and maybe it's a long-term thing, but that's a big number to pay. Okay, the next one here, tidy little building, you'd call this, wouldn't you?
Absolutely, and I think it's a classic example of a small-town market, a short drive from Toronto, and again, the barrier to entry is low. The unit rate is lower than the $150,000 in Burlington, so you get more bang for your buck. You get more suites.
Okay, so the next one here. This one we talked about earlier, isn't it? The Russell Hill one? Yeah, okay, so once you flip through those ones, yeah. Those are sweet deals.
They are,
right?
Lovely, yeah.
Yeah, okay. And the next one on Dufresne, I think we talked about that one also, right?
That's a big building. I think it's worth noting. It's a Flemington Park neighborhood.
Yes.
A couple of things jump out at me. One, it was a REIT to a REIT, a vendor purchaser, and the unit rate at $107,000 is not a big number for a good-sized suburban property.
Right.
I think there's room to reposition that property.
Okay, good. So here's a building in St. Catharines. So and so this is a very low price per unit.
Absolutely, and I think that you could find sales in St. Catharines easily in the $70,000-$80,000 suite range. And we talked about it earlier about who is the type of purchaser that's buying, and this would be a classic example of someone that's likely buying the property with some money in their pocket, and they're looking to increase value through suite renovation and moving rents over time.
Okay, great. So let's look at this sale here in Hamilton, and again here we've got a price of $51,000 per unit. This is in maybe a little tougher part of town, Wellington and King, in the Wellington King Street area here.
Downtown fringe, yeah. It's not the downtown area that's more desirable. In Hamilton, again, we can find unit rates in the $80,000 a suite range. So at $50 a door,
there's some latent value there.
I think people are looking at it as a value purchase, absolutely.
Right. Now this was a big building, 90 units. There was a Toronto buyer that bought this, a seasoned, experienced Toronto buyer has, come to Hamilton saying, they're what I call a price per pound buyer.
There you go. And I think it's important that you note the Toronto-based buyer, family active in apartments since the 1960s, so a lot of experience.
Right, and there's a second part of the building, sort of two buildings, side by side. Mm-hmm. Okay, so let's go on to this building here in Kitchener, right? So $92,000 per unit.
Yeah, it's a big number. There are a number of trades in the Kitchener, Waterloo, Cambridge, Guelph area in the mid-80s to the low 90s a suite, and that unit rate has crept up each and every year over the past 3 years. Maybe a benchmark of 70,000 to 75 to 80, and now it's 85 to 90.
Right, and look at this, London, $99,000 per unit.
Well, that jumps out at you because that's a
sure
really
does.
Big number for London, whether it's condo title or not. And I think I would think in the back of my mind, the purchaser, a very active multifamily investor, Niagara region-based investor, may be looking to upgrade the units and sell them as individual units as a retail play.
Yeah, that's actually a good point because the rents are only like $595 for the ones and $695 for the twos. Right, and they were purchased together with another building which we're showing here again with that combined price of $99,000 per
at that unit rate, Derek. My guess would be that there isn't a significant amount of yield, and to that end, I think it might be.
It's a repositioning play.
Or a resale.
Right. Yeah. You mean a resale individually to the marketplace?
It would be my best guess.
Right. Okay, all right. So here's a building in Tillsonburg.
This one jumps out at me for a couple of reasons. One, it's 5 stories, which means it almost certainly has an elevator.
It's an elevator, yeah.
Absolutely. And when you get into a small town such as Tillsonburg, there's only going to be so many buildings that have elevators.
Yes.
It's a competitive advantage when you're looking to the senior market.
You bet.
And the unit rate at $59,000, I think it's great value for an elevated building.
Yeah, I mean, you couldn't build that thing for $150 today.
Yeah.
Right? And you're buying it for $59,000. Okay, terrific. All right, great. Okay, let's go to the next one here. Lancaster. This one's in Kitchener again.
It's an interesting trade for the simple fact that a handful of sales, the majority of sales rather, in Kitchener Waterloo are probably in the $70,000 to $90,000 a suite range, and here we are at $41,000 a unit. There's so much room to reposition this property through renovation. At the same token, it would be a very capital-intensive exercise. Any purchaser would need a lot of money to make it happen. Also worthy noting, went on to Google again, and the property's right on the Conestoga. You can see that you're looking.
Yeah, you can actually see the highway there, right? So there's two properties sold side by side. So let's go into this next property here in Aurelia, because we don't often talk about it. That doesn't look like just a nice, cute as a button type building.
Absolutely, and I think that this is a perfect example of a mid-market trade that would be viewed as a pension fund, so to speak, for a private investor.
Right.
Unit rates perfectly reasonable. In fact, like you mentioned, maybe half of replacement cost, and you know, you maybe need about $450,000 to close this deal. You're probably buying in Aurelia at somewhere around a 6.5% cap rate, and borrowing money at 3.25. So you're looking at a double-digit distribution before amortization.
Right, and we think like there are, you know, 25,000 buildings in Ontario. The majority of them, 20,000, are in this smaller group of buildings, right? And so people say there aren't a lot of apartments for sale. That's true, but it doesn't mean that there aren't a lot of apartments available to buy if you do your homework and figure out the areas that have the best upside, and you start buying buildings that can be repositioned in those areas where the income is high, the migration to the population is growing, and the building has sort of the right things wrong with it. Okay?
I think that speaks exactly to the benefit and the strength of buy-side brokerage, and again, it speaks to the expertise, the knowledge, the information that could be gleaned from a broker that has a significant infrastructure and a perspective on the market that you do. So
yeah, well, thank you. We appreciate that. Okay, so this is the last building we've got, and again, you know, just a lovely looking building in Ottawa.
It is, and a couple of things jump out at me. One, the unit rate is low. At 100,000 in Ottawa. Ottawa and Toronto are very similar in the context of unit rates and cap rates for the most part. The other thing that jumped out at me when I took a closer look at the building is the neighbor to the south is a Porsche Audi dealership. And I toured around the neighborhood again using Google Earth, and it's a nice, low-density residential subdivision.
In East Ottawa, which doesn't have the highest rents, right? I mean, in Montreal and St. Laurent there, right? So the rents are under $1,000 for the 2 bedrooms.
I think it's good value.
Yes. No, on a per pound basis, it would cost you $220,000 per unit to build this thing, or $200,000 more per unit.
Yeah, it raised my eyebrow in terms of a value purchase.
Yeah. And so we're doing this seminar in February of 2013. Since we're talking about new construction, I just want to remind you that we've got really Canada's first symposium on new apartment construction on May 7th, and we've got a full day roster of speakers from across Canada and from the U.S. coming down to give sort of real world practical advice on new apartment construction. And we also have you know, the student house. Sorry, that's May 8th. On May 7th we have the second annual student housing symposium. We ran a symposium last year, just had a terrific response to it, and so we're redoing that again with speakers from across Canada and the U.S. So registration is in full swing for both these events. Just go to our webpage and you can sign up for it. We just launched our new Rock webpage. So the webinars for the rest of the year, these are free. For people to join. We typically have well over 100 people joining us for these webinars, and we'll also, if you are on the webinar today, you'll be sent an email with all these slides, and the recording will be posted on our website. We get a lot of feedback from our listeners and a lot of colleague brokers who are on the line here. But and we get these, and when people, we think about future webinars and guests here, we get a lot of the suggestions we get are from our listeners. So if there's a topic that you'd like us to talk about, or a guest that you'd like to have on, please drop me an email. So thank you very much to all of you for joining us for this webinar. And Phil Deschenes and Darryl McCullough, thank you again for your assistance here.
It's been a pleasure, Derek. Thank you.
Thank you.
Okay. Thank you.